What if the government just... What if the government just announced something that could genuinely change the economic trajectory of this country? And almost nobody noticed because they were too busy arguing about whether they like Carney? That's where we are today. Yesterday, buried inside the spring economic update, was an announcement that deserves a serious conversation. Not a cheerleading session, not a hit piece, a real conversation. Canada just created its first sovereign wealth fund. And I'm going to tell you exactly when that's a great idea. And exactly when it becomes just another mechanism that looks democratic on the surface and delivers for someone else underneath. Because the difference between those two outcomes isn't ideology, it's structure. Let's start with what was actually announced. The Canada Strong Fund launches with a $25 billion federal contribution. It will invest alongside the private sector in ports, mines, energy corridors, and critical infrastructure. And here's the part that's getting attention. There will be a retail investment product, meaning ordinary Canadians can buy in, participate in the returns, have a stake. On the surface, that sounds like exactly what people like me have been arguing for. Stop treating public assets as liabilities. Build things. Let Canadians benefit. And I mean that. If you've read my book, you know I've spent a lot of pages documenting how the system has consistently converted public value into private returns. Housing, energy, financial services. The pattern is remarkably consistent. So when a government says, we're going to build and we're going to make sure Canadians share in the upside, that's the right instinct. The question is never the instinct. The question is always the mechanism. Here's what I've learned studying how economic systems actually work over decades. Good intentions don't survive bad structure. A sovereign wealth fund is a powerful tool. Norway's government pension fund, built on oil revenues, is worth over $2.2 trillion. It funds public services. It stabilizes the economy. It genuinely works for ordinary Norwegians. But Norway's fund was built on a simple principle. The resource wealth belongs to the public. The returns belong to the public. And the management is insulated from the people who would most benefit from capturing it. That insulation is everything. So here are the conditions I'd apply to the Canada Strong Fund, the things that would tell me this is the real deal. Condition 1. Arm's-length governance that actually means something. Not a board stacked with Bay Street veterans who spent their careers on the other side of these transactions. The whole history of public-private infrastructure in this country is private capture of upside, public absorption of risk. If the governance structure replicates that, the fund is just a new delivery mechanism for the same outcome. Condition 2. The retail product has to be genuinely accessible, not structured for accredited investors, not minimum $25,000 buy-ins wrapped in prospectus language that requires a lawyer to decode. If ordinary Canadians are going to participate in the returns, the product has to be designed for ordinary Canadians. Simple, low barrier, real returns. Condition 3. Project selection has to prioritize cost reduction, not yield extraction. This is the critical one. A sovereign wealth fund can be used to build infrastructure that lowers the cost of living, housing, transit, energy transmission. Or it can be used to build toll road-style assets that generate financial returns by charging Canadians for access to things they already paid to build. Those are not the same thing. And the difference won't be announced. It'll be buried in project selection criteria that nobody reads. Condition 4. Transparency that has teeth. annual public reporting on project selection rationale, independent audit, parliamentary oversight with real authority. Not a website update, not a press release. If those 4 conditions are met, genuinely met, not performed, this fund could be transformative. I mean that. But here's what history tells us to watch for. The announcement is deficit financed. Canada doesn't have $25 billion sitting in a resource account the way Norway did. We're borrowing to invest. That's not automatically wrong. Governments borrow to build all the time. But it does mean the retail investment product has a specific risk. If Canadians are buying into the fund, and the fund is built on government debt, Canadians may essentially be buying Canada's own debt back from itself, with financial intermediaries taking a cut in the middle. That would be a very familiar pattern. I'm not saying that's what's happening. I'm saying that's what to watch for. The second thing to watch. The phrase "alongside the private sector" can mean a lot of things. It can mean private capital is drawn in by public de-risking, which is a legitimate tool. Or it can mean public capital backstops private returns, which is the thing I've spent a book documenting. The details will tell you which one it is, and the details won't be in the press release. So here's where I land on this. The Canada Strong Fund is the right idea at the right moment. The instinct to build, to own, to let Canadians share in the returns. That's exactly the conversation we should have been having for 30 years. Whether it becomes what it could be depends entirely on 4 things. Who governs it? Who can access the retail product? What gets built? And whether the public can actually see what's happening. Those aren't cynical questions. They're the only questions that matter. I'll be watching closely, and I'll be reporting back here when the details emerge. If you want to follow that conversation, subscribe, hit the bell, because the announcements are always the easy part. The structure is where the story is. And if you want to understand the deeper pattern behind how these mechanisms work and why they so often deliver differently than they're announced, the link to my book is in the description. I'm Glenn Kosky. Thanks for watching.